They don't want you to know this. Have you ever wondered why some people become millionaires, even billionaires, from the crypto market, while most people only see losses, risks, and unpredictable volatility? The harsh truth is that this market is not for everyone. Only those who know how to play by the rules of the sharks and whales can win. If you have ever found yourself confused by the dizzying price increases and then the panic declines, if you have ever bought at the top and then sold in panic, you are not alone. This is not because you are unlucky or not smart enough. The truth is there are secrets that the people who really control this market never want you to know. Because when you know them, you will no longer be prey. You will know how to protect yourself and even take advantage of this game to make a profit. In the past few years, the crypto market has changed dramatically. More and more large organizations are participating. New strategies are being applied. And the game is getting more and more complicated. If you still think you can rely on social media, news, sentiment, or advice from community groups to make money, then you are being left behind. Today, I will share with you 3 important secrets that the sharks and whales in the cryptocurrency market always try to hide. This is not only information to help you understand how this market works, but it will also help you know how to act smarter, avoid being manipulated, and take advantage of opportunities for yourself. You do not need to be a financial expert or someone with millions of dollars in an account to apply these things. Anyone can learn and change their mindset if you are really serious, and I believe that if you are watching this video, you are someone who is truly interested in mastering your finances. Before going into the main content, I want you to do a simple but extremely important thing. Leave a comment with the sentence, "I am ready," right below this video. This is not just a comment, but a commitment from you to yourself that you will no longer be a passive participant in this market. I will thank you for every comment because I know that everyone who leaves one is really serious about their change. And if you want to continue receiving valuable information like this, don't forget to like the video, subscribe to the channel, and turn on the notification bell. Each of your likes will help this video reach more people who need it. Subscribe to the channel so you don't miss the financial secrets that I will continue to share. And please share this video with your friends because, who knows, just a little information might change their financial future. Are you ready to discover these 3 secrets? Come with me into the first secret. The first secret that sharks and whales don't want you to know is how they actually make money. Assuming this replaces the garbled text, SKBC-ing. If you believe that they get rich just by buying low and selling high like small investors, then you are mistaken. In fact, they use much more sophisticated strategies to maximize profits. And more importantly, these strategies often ensnare most small investors in the traps they set. Imagine this. You see a cryptocurrency increase sharply in a short time. News is everywhere. Investment groups are talking excitedly. Everyone believes that this is a rare opportunity. You jump in and buy right away because you are afraid of missing out. But then what happens? The price starts to plummet. You panic, cut your losses, and just a few weeks later the price skyrockets again. But at this point, you have lost money. This is not a coincidence. It is the result of a strategy called pump and dump. Pump the price and then dump it. This is how whales manipulate the market. They can be large organizations, investment funds, or individuals who own a huge amount of assets. When they want to sell a coin at a high price, they will create a wave of positive news, inflating the expectations of small investors. When the crowd gets caught up and buys in droves, whales will gradually sell their coins at the highest prices. Then, when no one is buying anymore, the price plummets, and the ones who suffer are those who arrive late. A typical example is Bitcoin. At the end of 2017, when the price reached nearly $20, people rushed to buy in with hope, hoping it would continue to rise. But then the price plummeted and lost over 80% of its value within a year. Who sold at the highest price? The large holders of Bitcoin, also known as the whales. How do you avoid falling prey to these games? First, don't get caught up in the herd mentality. When you see a coin being hyped, ask yourself, who is benefiting from this? It may not be you. Second, watch the trading volume and whale wallets. Large transactions often leave a trail. And if you see large amounts of money being withdrawn from exchanges or transferred to unknown wallets, it may be a sign of an impending sell-off. Finally, Have a long-term strategy instead of chasing short-term waves. Invest in projects with solid foundations and hold for the long term. The richest people in this market are not the ones who trade constantly, but the ones who patiently hold assets that have real value. The second secret the sharks and whales don't want you to know is that they make money even when the market is down. Have you ever wondered why some people are still getting rich even when the market is down? They don't panic sell, on the contrary. They take advantage of the declines to increase their assets. The secret lies in two important strategies: derivatives trading and accumulation during panic. First, let's talk about derivatives trading. Unlike small investors, who often only know how to buy and pray for the price to increase, whales use futures and options to make money even when the price drops. For example, when they predict that Bitcoin is about to drop sharply, they don't panic sell. Instead, they open short positions, which means betting that the price will drop. If Bitcoin drops from $40 to $20, example, they profit from that decline. While small investors are desperately watching their accounts being depleted, whales can still make huge profits. In addition, whales also employ an extremely important strategy: accumulating during panic. When the price drops sharply, instead of dumping, they buy silently. This strategy is sometimes called buying the dip. Look back at the times Bitcoin bottomed out in history. In 2018, when Bitcoin dropped from nearly $20 to around $3, how many people dared to buy then? Almost no one, because everyone was scared. But those who bought at that time likely became millionaires when Bitcoin returned to $69 in 2021. The same thing happened in 2022, when the market crashed after the Luna and FTX events. A lot of investors sold out because of fear. But who was the one who quietly bought when the price was low? It was the big organizations and the whales, and not long after that. When the market recovered, they likely made hundreds of millions more. How do you apply this strategy and not be crushed by the market? First, don't be afraid when the market drops. When everyone panic sells, ask yourself if this is a buying opportunity. Remember that history often repeats itself. Major drops are often followed by recoveries. Don't just buy when the price is already rising. If you buy when everyone is excited, you may be buying at the prices where whales are selling. Instead, accumulate when the market is falling. But choose projects with real potential, not obscure or anonymous coins. Learn how to use trading tools like futures or options to potentially protect your portfolio or profit from downturns. You don't necessarily have to use high leverage like professional traders, but understanding how to make money in both up and down directions will help you be less passive in the market. So what about the third secret? It can completely change the way you look at this market. The third secret that the sharks and whales don't want you to know is that this market is not completely random, it is manipulated. Many retail investors believe that the crypto market is a free place where prices are determined by natural supply and demand. But the reality is not that simple. Behind the numbers on the screen is a sophisticated operating system where whales can manipulate prices seemingly as they wish. Have you ever wondered why the price of Bitcoin often spikes right before a big news story? Why do some altcoins suddenly increase by hundreds of percent only to crash shortly after? That is often not a coincidence, but a result of market manipulation. Let's explore 3 common methods whales use to manipulate the market. First, wash trading, fake trading. Wash trading is when a whale or a group of whales buy and sell the same coin between their own accounts to create fake large trading volume. When you see a coin with a sudden spike in trading volume, you might think that a large number of investors are participating. But in fact, it might just be whales putting on a show to attract inexperienced people to jump in. When the price rises to a certain level, they will dump, leaving small investors stuck with an asset losing value. Second, spoofing, placing fake orders. Have you ever seen a huge wall of buy or sell orders appear on an exchange's order book, making you think that the market is about to make a big move? That could be spoofing, a technique whales use to fool investors. They place a large number of buy or sell orders to create the illusion that the market is trending strongly. When small investors react to them, the whales immediately cancel those fake orders and make trades in the opposite direction. This helps them buy or sell at the most profitable prices without having to commit too much capital. Third, stop hunting, or liquidation hunting. If you trade futures or use leverage, you may have experienced this feeling. You place a long or short order with a careful stop loss. But the price accidentally touches that point and then reverses in the direction you originally predicted. It's often not by accident. The sharks know exactly where the majority of retail traders place their stop losses. They have the tools and data to determine the price levels where many stop losses are clustered and where many leveraged positions will be liquidated. When they want to accumulate assets cheaply, collect cheap goods, they might push the price down to trigger those stops, forcing retail investors into panic selling. Then they accumulate the assets and push the price back up. So how can you avoid being manipulated? First, don't trade based on your emotions. If you see a coin suddenly skyrocketing or news that gets the whole market excited, ask yourself, who is benefiting from this? If the answer is not you, then pay attention. Secondly, look at on-chain data. Big transactions often leave a trail. There are many tools like Whale Alert or Glassnode that help you track the money flow of whales. If you see large withdrawals from an exchange, they might be preparing for accumulation or a longer-term hold. Thirdly, don't over-leverage. If you are using too much leverage, you are putting yourself in a vulnerable position. Sharks love to profit from overly greedy or leveraged traders. So always manage your risk appropriately. Now you know the 3 important secrets that the sharks don't want you to know. But this is only part of the big picture. How can you leverage this information to actually make money from crypto? Now you know the 3 secrets that the sharks and whales don't want you to know. But the most important question is, how can you leverage this knowledge to actually make money in the crypto market instead of remaining prey? First, you need to change the way you think about this market. Crypto is not just a game of buy low, sell high, but a complex financial ecosystem where those with the right knowledge and mindset often win. Let's explore 3 important principles that will help you not only survive but also thrive in this market. First principle: don't just focus on price. Focus on cash flow. Many retail investors only care about the price of a coin, but forget a crucial factor. Where is the money flowing? Whales rarely buy when everyone is excited. They buy when no one cares, when the market is in fear. On the contrary, they often sell when the market is full of greed. So how do you track whales' cash flow? Use on-chain tracking tools like Whale Alert to see when large amounts of Bitcoin or Ethereum are withdrawn from exchanges. When whales withdraw large amounts, it can be a sign they are accumulating for a longer hold. Observe the total value locked, TVL, in different ecosystems. If TVL increases significantly, it can indicate that cash flow is pouring into that system. Follow major investment funds like Grayscale, BlackRock, or ARK Invest to see what projects they're targeting. What they buy can become the trend in the future. When you understand where the money is flowing, you will be less likely to get caught up in meaningless FOMO waves. Second principle: don't just chase the news. Try to stay one step ahead. Don't wait for the news to be announced before acting. The whales often know long before. By the time you read news in the press, they may have already completed their transactions. For example, when a coin is about to be listed on a big exchange like Binance or Coinbase, you might think this is an opportunity to buy. But, in fact, the whales may have bought it weeks or months before the news was announced. When you jump in to buy based on the news, you are often buying near the top. How do you stay one step ahead? Follow venture capital funds like A16Z, Multicoin Capital, etc., to see what projects they are pouring money into early on. Observe the development team's activities. If a project continuously releases major updates, it could be preparing for significant growth. Learn how to analyze on-chain data to see how large wallets are trading. Third rule: don't gamble. Invest based on probability. Many people see crypto as a casino where they bet everything on one coin, hoping it will go to the moon. But this is often the fastest way to lose money. Whales don't just play by chance. They invest based on calculated probabilities. Ask yourself, does this strategy give me a higher probability of winning than losing over time? Don't put all your money into one coin. Diversify your portfolio, not by buying all coins, but by selecting projects with long-term potential. Always have an exit plan before buying any coin. Determine the price at which you will sell to take profit and the price at which you will cut your losses if your prediction is wrong. Use the strategy of dollar cost averaging (DCA) instead of buying everything at once. Divide your money and buy gradually over time to minimize the risk of price fluctuations. When you invest based on probability instead of emotion, you will worry less every time the market fluctuates. Now you have 3 important principles to help avoid being manipulated by sharks. But how do you turn these principles into an effective investment strategy? Now you understand how sharks manipulate the market and the 3 important principles to avoid becoming prey. But understanding is not enough. The important thing is that you must know how to turn this knowledge into a practical investment strategy. In this section, we will explore a method to help you invest intelligently, limit risks, and maximize potential profits in the crypto market. This is the strategy of swimming with the sharks instead of confronting them. You will learn how to potentially take advantage of sharks' movements to make profits. Step 1. Choose the right battlefield. The crypto market is very large, with thousands of different coins, but not all are worth investing in. Sharks generally do not play with worthless coins long term. They focus on areas with large cash flows and real opportunities. You need to determine which projects have real potential and are not just coins inflated by news or short-term trends. How do you know that? Look at the market cap. A project with a large market cap is less susceptible to manipulation than a small cap coin. If you are just starting out, focus on established projects like Bitcoin, Ethereum, or major ecosystems. Check the liquidity. A coin with low trading volume is more vulnerable to manipulation. Choose assets with high liquidity to ensure that you can trade without significant slippage. Research the development team. Good projects always have a strong team and a clear roadmap. Don't just buy a coin because it is hyped. Look at who is behind it and what they are building. Step 2. Observe and learn from the whales. You don't have to guess the direction of the market. Just try to follow the patterns of those who seem to be influencing it. There are many ways to do this, but 2 effective methods involve tracking whale wallets. Large transactions always leave traces on the blockchain. Use tools like Whale Alert, Nansen, or Glassnode to see what whales are buying, selling, and when they are moving their assets. Watch exchange flows. When you see large amounts of coins being deposited onto exchanges, it could be a sign of impending selling pressure, a potential sell-off. On the contrary, if whales withdraw assets from exchanges, they could be preparing for a longer-term hold. Remember, whales rarely buy when everyone is buying and rarely sell when everyone is selling. When the market panics, they often silently accumulate. When everyone is greedy, they often start distributing, selling. If you observe their actions, you might be less caught up in emotional waves. Step 3. Build a reasonable investment strategy. After choosing the right projects and observing the whales, you need a strategy to optimize potential profits and limit risks. Below is a simple but potentially effective model for dividing your portfolio into 3 parts. Part 1: 40%, example allocation. Invest in more established assets like Bitcoin and Ethereum. This provides a foundation to help make your portfolio less volatile. Part 2: 30%, example allocation. Invest in projects with high growth potential but still having a solid foundation, such as promising layer 1s, DeFi protocols, or emerging blockchain ecosystems. Part 3: 30%, example allocation, for higher risk, potentially shorter-term opportunities where you might take advantage of volatility for quicker profits. But always set a stop-loss to protect your capital. Apply the strategy of DCA, dollar cost averaging, instead of buying all at once. Divide your capital and buy gradually over time. This helps you reduce your average entry cost risk and avoid being overly affected by short-term price fluctuations. Always have an exit plan before investing in any asset. Ask yourself, what is my profit target? How much loss am I willing to accept? This helps you control your psychology and not get carried away by the market. When you apply these principles, you will start acting more like a professional investor instead of someone just following the crowd. And this is a way to potentially make money from crypto more sustainably. But there is another crucial factor, your mindset. Because even if you have all the tools and strategies, if you don't have the right mindset, you can still fail. Now you have the strategy in hand. You know investment strategies, how to observe the sharks, and how to control risk. But there is one thing perhaps more important than all of that: the right investment mindset. The crypto market is not a place for the mentally weak. It is a battle between those with strategies and those who act on emotions. The sharks know how to manipulate crowd psychology to make a profit. If you do not practice a solid mindset, you can easily become a part of that crowd. Lessons from successful investors. Look at the great investors. Whether in the traditional market or crypto, they have common traits: patience, discipline, and the ability to control emotions. They do not panic when the market drops. When Bitcoin dropped from $69 to $15, approximately, many people sold. But knowledgeable investors often took advantage of this opportunity to buy. When the market recovered, they were often the biggest beneficiaries. They do not FOMO when the price increases sharply. If you feel excited when you see the price of a coin increase dramatically in a day and want to buy immediately, stop. The sharks might be selling to people like you. They always have a long-term plan. Investing is not typically a short-term game. Real moneymakers in crypto are often those who know how to wait and take advantage of time. Controlling psychology is often the deciding factor for success. Have you ever felt happy when the price goes up but worried when the price goes down? Do you read the news every day and constantly change your investment decisions? Do you see others making huge profits and feel like you are missing out, FOMO? If so, it is a sign that you are being controlled by the market instead of controlling the market. Remember, crypto is largely a psychological game. The winner is not always the smartest person, but often the one with the strongest mentality. How to control psychology. Limit exposure to news and social media noise. Too much news can just make you worry or induce unnecessary FOMO. Focus on your own strategy. Always have a plan before investing. If you have determined your entry and exit points in advance, you will be less swayed by market fluctuations. Don't compare yourself with others. There are always people who make more money than you. And there are also people who lose more money than you. The most important thing is whether you are following your own plan. Commit to taking action, the first step to success. Now you have information you need to invest smarter in crypto. But if you do not take action, all knowledge is meaningless. Start with a small step today. Share your thoughts in the comment section. I watched the whole video. I will take action today. Set a clear financial goal. What do you want to achieve from crypto in the next year? Plan your investment according to the principles you have learned. Write down your strategy and commit to following it. Remember, success does not come just from what you know, but from what you do. If you found this video useful, don't forget to like it. Subscribe to the channel and share it with your friends. Each of your likes and subscriptions helps more people potentially avoid the shark traps and build a more solid financial future. See you in the next videos, where I will continue to share strategies to help you master your finances and potentially succeed in the crypto market.